Hey, good morning, everyone. It's Sunday. I'd originally planned on doing this little video from there's a little dock around the bend up here on Oldman's Creek. I was going to do a video from there. It'd be kind of nice back there. But dang it, the biting flies are so bad that when I tried to go through the woods to get there, they're like little kamikazes. They bite hard and they leave very irritating marks, especially on me. So heading back to the house, I'll do my video from there. All right, see you in a bit. Okay, I'm back at the house now. So I had a friend from down south ask me the other day after seeing, I guess, Jerome Powell's Jackson Hole speech about interest rates potentially loosening up here in coming months. If I thought that was a good thing, did I think it was going to be inflationary, or did I think that it was going to have really no impact on inflation whatsoever and might make lending practices a little easier? And my response to that would be I think it's too early to tell. So I don't think some people understand exactly how the Federal Reserve and their interest rates work. The Federal Reserve sets what is called the Fed funds rate. And think of the Fed's funds rate as kind of like minimum wage for interest rates. In other words, you're never going to get interest rates below the Fed funds rate, but individuals don't ever get the Fed funds rate. The Fed funds rate is the rate that banks and credit unions, basically lending institutions, charge each other for overnight loans. And, the Federal Reserve, when it was set up back in 1913, was originally, the only thing they were supposed to be there for was to ensure liquidity through the banking system. And they would do that by pretty much acting as a clearinghouse. Let's say you had a bank that loaned out $105 when it only had $100 to loan out one day, and then you had another bank, maybe across the state or across town, that they loaned out $80 when they had $100 to loan out. Well, the Federal Reserve was set up to kind of set the interest rate and ensure that those banks had a mechanism for covering for each other in the case that reserves dropped below levels that were required in the banking system. So, also, what most people don't, I think, understand is that even though the Federal Reserve lowers interest rates, that doesn't mean all of this money is going to start going to individuals or even commercial organizations. You see, the transmission mechanism for money is actually the banking system. So the Federal Reserve sets, like I said, overnight rates for the banking system, but still it's the banking system that then makes decisions to loan out money on an individual case basis. Now, here's what I think is going to happen. I still think we're in for a major economic crash, and I'll tell you why. There's three reasons. One is credit card debt right now. You've heard me mention the credit card debt's at a pretty much it's an all-time high. I heard a report that said more than 50% of households right now are paying more in interest payments on their credit cards than they're paying interest on their mortgages. That's scary as all get out. And delinquencies on credit cards are at a 15-year high as well, as are auto loans. There is a huge percentage, I think, in the low 20s or something, of auto loans, and almost 50% of new car auto loans the payments are above $1,000 a month. So auto loan delinquencies are also at a 15-year high. So when you couple the credit cards with the car loan defaults, so credit card defaults and car loan defaults, and look, quite frankly, the housing market, houses are 45% higher today than they were in 2020, right before the great cough apocalypse of 2020 started. So house prices are just unaffordable for most people at this point. That's a three-legged stool that if any one of those legs goes, I think the whole stool comes down. And unlike what happened back in the 2008 2010 timeframe, when it was largely a credit issue tied to housing, I mean, many other sectors of the economy were still very healthy at that time. But when the housing market crashed, you get this what's called negative wealth effect when people's house prices start dropping. They stop spending money, and then it kind of propagates itself throughout the entire system. But what I'm saying here is I don't think that the Fed pivoting on interest rate hikes is necessarily inflationary, because I think there's too many other issues now in the economy, and I just don't think people have the money to spend. Could be wrong. This could be inflationary again, and if it is, that's really bad, because then we're going to have inflation and higher unemployment, which is, again, I've mentioned yesterday, stagflation. But yeah, I think what we're looking at is just, again, probably a 2008 to 2012 type event, but much more severe than it was at that time. So, happy Sunday morning. I hope everybody has a great day. It's nice weather here today, so I'm going to probably get out in the workshop. But take care. Talk to you again soon.